There's a lot of back and forth here on YouTube and in financial media, personal finance media, as to whether or not you should pay your mortgage off early. And when we say mortgage, we're not talking about investment properties, we're talking about your primary residence. Of course, if you've got your mortgage paid off, there's a lot of peace of mind that comes with that because you relieve yourself of what is most often the most expensive recurring bill that you have. Now, there's nothing wrong with thinking that paying off the mortgage early is a good idea. However, we believe that you should concentrate on being able to pay off the mortgage early, not necessarily doing that, but having the ability to do it. And we're going to talk about why. Now, the other school of thought is that you should not pay off your mortgage early because it's usually the lowest interest rate money, unless you've got maybe student debt sometimes is a little lower, but your mortgage debt usually is the lowest interest debt that you have. So you could conceivably go out and get a return that exceeds the mortgage interest rate. So you could play the arbitrage game and make some money by using the money that you would otherwise put on your mortgage. And that's basically what we here at Money Changes Everything suggest that you do. You should have the ability to pay off your mortgage. So you should concentrate on putting extra money away so that at some point you can put that money onto your mortgage if you desire or if you need to in order to get rid of that mortgage. You don't necessarily want to, and I actually think it's a bad idea to send extra payments to the mortgage company. And for quite a few reasons. Number one, when you do that, you're locking that money in to the equity in your home. So you're not able to access that money. It's not uh, liquid any longer once you send those additional funds on top of whatever your regular mortgage is. Once you send an extra payment into the mortgage company, it's no longer liquid. In fact, in order to access the equity in your home, you have got to get either a home equity loan, home equity line of credit, reverse mortgage. You've got to be a certain age to do that, or you got to sell the home. So every mechanism that you would exercise in order to realize your equity in that home is then dependent upon someone else making a decision to allow you to do that. If you sell the home, you've got to find a buyer who is willing to meet in the middle on a particular price that you all agree to. A reverse mortgage, again, you have to be a certain age to employ that tactic. And as far as a home equity loan or line of credit, a bank has to sign off on that and give you permission, basically, to access your equity. So while you're home, you may feel really good about the fact that the value of your home has appreciated over time, and that's definitely something to feel good about. However, that equity, that value that you're realizing is locked in. It's not liquid. You've got to do though one of those four things we just talked about in order to access that money. And you may not want to sell your home, okay? You may not be able to get a home equity loan or line of credit. Think about it like this. If someone had an appreciable amount of value that was in their home, and then they got laid off in this whole thing that happened last year in March and April 2020, where literally millions of people lost their jobs. A bank is not going to let you get a home equity line of credit or a loan based on the value of your home unless you have some income coming in. And if you no longer have the job, then of course you can't show that you have the income. So oftentimes when you most need money, it's not available, not from a lender. And when you're flush and you don't really need money, you've got credit card offers arriving every day of the week. So sending those extra payments in to the bank, that's not something that is advisable. It's not something I would recommend. It's not something I would do, because you are turning liquid money into illiquid money. Okay. Now, so then you try to decide, what then should I do? How should I structure this? Well, again, we're operating off of the premise that what you want to do optimally is have the ability to pay off that mortgage. So let's say you have a 4% interest rate on your mortgage, just for argument's sake. If you're able to go out then and put that money into a vehicle that is earning 6%, then why wouldn't you rather do that? You're actually making 2% beyond what you're paying on the mortgage interest. The other thing about the mortgage, paying it off early, you do have to consider this and how big of a factor this is in your personal situation. The mortgage interest tax deduction. You've got to take a look at that, talk with your CPA, your tax preparer. If you pay off your mortgage early, then you would no longer be receiving that. So that's a factor as well. Putting the money into a vehicle that is getting a return that exceeds the interest payment on the mortgage is something that over time is going to allow that money to grow. And optimally, at some point, you'll be able, if you want to pay that mortgage off in one fell swoop, or to at least have the money. Let's say, some unforeseen economic circumstance occurs and you need the money from this account that you've been putting, this mortgage account that you've been building. You need to pay a few months of mortgage with that. You have the ability to do that. And all the while, you're making 2% in our example, just to make the numbers work and make it a simple example. You're making 2% on top of what you would have been really doing if you put the money directly on the mortgage. Okay. So yes, it is a good idea to be able to pay off your mortgage early, to have that peace of mind. However, you should also consider being able to do that in a smart way, a way that's not only going to result in you paying off the mortgage, but it's going to allow you to maintain that mortgage interest tax deduction, and it's going to allow you to make a return in another vehicle, so that when you do pay off that mortgage, because remember, every mortgage payment you make is really cutting down that interest payment, and it's more of it is going into principal. So if you've got a static amount of money, say you want to put $500 additional on your mortgage every month, you're putting it into this other vehicle, whatever that may be. Maybe it is a mutual fund, an index fund, a cash value life insurance policy that's been properly structured and that you can take money out of tax free. If you're doing that, then that's a smarter way than just giving that $500 to the bank and allowing them to just lock it in and really, not let you have any of it unless you get a home equity loan, line of credit, sell the home, or a reverse mortgage. So my recommendation is, if you want to pay off your mortgage early, the mortgage on your primary residence, then what you should seriously consider is looking into a vehicle that gets you a return on your investment that exceeds your mortgage interest rate, allows you to maintain that mortgage interest deduction, and allows you to maintain that all-important liquidity. And if you really want to supercharge this concept, you should consider holding that money in a properly structured cash value life insurance policy, because you will get 3 very key tax benefits, and they include the Section 72E IRC, Internal Revenue Code Section 72E protection, which allows your money to grow tax-free. It'll give you IRC, Internal Revenue Code 7702 protection, which allows you to access your money tax-free. Remember, the mutual fund and the index fund, they're not going to do that, okay? You're going to be taxed on the growth of that money when you go to access it in form of capital gains tax. You're also going to be taxed in terms of the dividends, any dividends uh, at your income tax rate. That's what the uh, president currently is suggesting. And he has control of the House and Senate, so he just might get that. But with a properly structured cash value life insurance policy, you also get a third very important tax benefit, which is the ability to distribute that money to your heirs tax free under IRC Section 101A. And you get all of this, plus you can structure a life insurance policy so that it gives you other benefits that mitigate healthcare costs, for example. So there's a lot to it. Life insurance is definitely something that is not about death and dying. It's about living benefits if done properly. And that might be the ideal place to put money aside to help you build this mortgage fund that you're going to get so many benefits from. Again, liquidity, 3 tax protections, the ability to maintain your mortgage interest tax rate. That's a lot. Okay, that's a better strategy in terms of being able to pay off your home early. It's all about having the ability to do that and doing it in a smart way.